President Lagarde, ladies and gentlemen, dear friends. I'm very pleased to welcome you today to this conference, which brings together the ECB and its watchers since 1999. Today's event is the 24th installment in the series. I'm delighted. I made a note for that myself, that here I see Axel Weber sitting here, and in principle Ottmar Issing will also be here. I don't see him right now, but they founded this conference in '99. And actually Ottmar recently wrote a paper on the importance of central bank watchers in this kind of forum, and we will have that ready at the welcome desk, so if you're interested in that. Also, it is actually great to have all three former ECB chief economists here today, Ottmar, Jürgen Stark, Peter Praet, both sitting here. You have been in the hot seat at the ECB Watchers Conference, and I'm very happy that Philip Lane, who is also sitting up here, is continuing the tradition. Thank you very much. When we met last in March 2023, core consumer price inflation stood at 5.3% and was still rising. The ECB had raised the deposit facility rate, the key rate, to 3%. It had done so in spite of the turbulence in the banking system and the collapse of Silicon Valley Bank and Credit Suisse. Yet, money market rates were still below core and headline inflation. The short real rate was still negative. Now, with more rate hikes under the belt, the deposit rate stands at 4% since September, while core inflation is 3.1%, headline 2.6%. So policy tightening has delivered a positive short-run real interest rate. Over the last year, policy moved towards what is called the Taylor principle in the economics profession. However, domestic inflation remains higher. I like to consider the broadest measure of that, that's the GDP deflator, and by that domestic inflation was 5.3% in the last quarter, and the ECB staff estimates it to come down to 3.4% in the current and 3.2% in the next quarter. So markets and experts expect all measures of inflation, basically many of you are here, you expect inflation to decline further. We expect inflation to decline further, and throughout the year, later in the year, interest rate cuts to follow. How far they may decline, that could be a question to discuss in the first panel, the first debate on inflation and monetary policy. I think last year's decision to keep tightening policy throughout the financial turbulence proved to be the right one. The euro area banking sector has withstood higher rates surprisingly well. And in the second panel after lunch, we'll take a deep dive into monetary policy transmission via the banking system and perhaps the role of prudential policies in this context. The third panel will take a broad look at the policy implications of geopolitical risks. We are in the third year of the Russian war of aggression on Ukraine. And in October 7th last year, the Jewish holiday of Simchat Torah, the Hamas organization of Gaza carried out a horrible terrorist attack on Israel and started a war with awful consequences for Gaza itself. And tensions in the Far East with China over Taiwan continue to remain of significant concern. If we look closest to home, the situation in Ukraine, it looks very difficult. There's a lack of weapons, ammunition, soldiers, and importantly, US support. I think Europe needs to step up to the plate and provide the ammunition and weapons that are much needed. Also, we need to watch out, and this is closer to home for us, that our regulations and investment criteria are not applied in a way or misapplied in a way that hinders the fast buildup of our own defense industry and defensive capabilities. In the Middle East, the attack of Hamas on Israel had the explicit goal of triggering a large war, a war that draws in many states into armed conflict. Fortunately, this has not happened, or at least has remained limited so far to rocket attacks by Hezbollah and Houthi militias. Actually, more than 50 years ago, on October 6, 1973, Egypt and Syria launched a surprise attack on Israel on the Jewish holiday of Yom Kippur, and that has become known as the Yom Kippur War or the October War. It was accompanied by an oil embargo of Arab OPEC countries on Israel allies. And actually, there are several similarities between the Arab-Israeli war and the global energy crisis that we're facing today. I think it's of interest to compare the macroeconomic consequences of the two periods, or the consequences on a macroeconomic perspective. So I have here, just to start us up, a chart that overlays US consumer price inflation for the two episodes. So basically it's shifted so you get the closest match. And the two vertical lines mark the dates of the oil embargo in 1973 for the blue line, that's the inflation in the 70s in the US, and the Russian attack on Ukraine in 2022, February 2022, for the orange line, which is the experience of the US inflation in this episode. In the 1970s, inflation started out at a higher level, but in terms of the speed of the rise and decline in inflation, the episodes look surprisingly similar. Of course, and you can see that in the dashed line, we expect inflation to decline as indicated by this dashed orange line. In the 70s, inflation rose again, we all know that, and interestingly, I thought I mentioned that since Richard Lagarde is here. He published an article 24 years ago that suggested this was at least partly due to the Fed's failure to implement the Taylor principle. You can say I'm wrong in the panel, but anyway, well, we can discuss it further. How does the picture look for the euro area? Here's the picture, same picture for the euro area. In the 70s, the inflation experience in Europe was very heterogeneous. Here I show basically the average of inflation rates, CPI inflation rates for Germany, France, Italy, and Spain. So it's not directly comparable because these were, of course, not economies in a multi-union. But nevertheless, it's interesting how similar the increase and decline looks like. There is still a level difference. Inflation started out quite a bit higher for that average. The increase in 2020-21 was a bit faster than in the 70s. The decline in inflation was roughly similarly fast, but it stopped earlier in the 70s. One could think of lots of questions, but we have great speakers coming up. So let's see what we learned from the contributions throughout the conference today. So President Lagarde, we are very grateful that you are starting us off with your presidential address. Thank you very much for your commitment to this event over the years. I think that's a key to make this happen in a very successful way. Everyone here, of course, knows you and your exceptional career and the many positions of great responsibility you have held in past years. So I will not list your many accomplishments in detail, but let me say this, I'm sure that your wide experience in policy and politics, in government, as minister with several different portfolios, at the helm of the International Monetary Fund and the European Central Bank, with multi-fiscal, financial, and geopolitical matters. So that your experience in this way, I think, is a great asset as the ECB has to navigate this complex monetary, fiscal, financial, and geopolitical environment. So without much further ado, may I ask you to the podium.
Well, thank you very much, Professor Wieland, and thank you for sitting next to me. It's nice not to be alone on this wide podium in front of this respectable audience. Very large number of men in this room, if I may say. Sorry, couldn't help it. But I'm delighted to be back here in front of you for this 24th conference of the ECB and its watchers. in an environment that I will not bother to describe because you've done that beautifully, Professor Wieland. And all I will say for our own purposes is that we are not in a less threatening environment from a geopolitical point of view, far from that. And if we have settled some score with inflation, we are looking at the world, and I think it goes beyond even the places that you've mentioned. If we look at other places, notably in the Republic of Congo and other places where war is just ramping around, which, as we all know, is probably the most adverse event to derail growth, to unsettle societies, and to cause great, great damage, as we will be learning fast in relation to Ukraine. And I agree with many of the comments that you've made in that respect. Not that it would matter for inflation, of course. Well, it does, actually. But anyway, what I would like to do this morning with you is reflect on the journey that we have traveled in the last year and a half or so, and describe for you what I regard, together with my colleagues and friends, members of the Executive Board who are present in the room, and my colleagues from the Governing Council who are also here today and will participate in panels, as the three phases that we have navigated, or are navigating, or will be navigating. So, bear with me, some of that will sound terribly familiar because we have already, all of us, and you certainly have, dissected the first phase in particular and are dissecting the second. But I think that to see things in perspective actually helps understand where we are and what we are planning for the near and more medium-term future. So since the pandemic, we monetary policymakers have been facing an exceptionally complex environment. As inflation rose, we were confronted with profound uncertainty about how far it would go, how widely it would spread, and how deep it would dig. And even as inflation has eased, uncertainty about its persistence has remained. The potential costs of miscalibrating policy have been high, which is why we had to employ a policy framework that minimizes the risks of mistakes. And we have done so by building up a framework and our reaction function around three criteria that you are familiar with. One is the inflation outlook, the second is the dynamics of underlying inflation, and the third is the strength of monetary policy transmission. Though we conceived these criteria when we had low visibility of future inflation, they have also helped guide our decisions as inflation has fallen and forecasts have become more accurate. As Marie Curie once said, to thrive through the ups and downs of life, we must have perseverance and, above all, confidence. And our framework has indeed encouraged us to persevere when necessary and to build confidence when needed. It has served as a reliable compass for calibrating policy through three phases of our current policy cycle. First, it helped create robustness during our tightening phase when we were devising how far we needed to go to rein in inflation. Second, it has helped us practice patience during the holding phase until the signals from our inflation projections and underlying consistent are more consistent. Third, it will support us in building up sufficient confidence to begin the dialing back phase in which we make policy less restrictive. So let's have a look at the tightening phase, which is the first one that some of you have observed very, very closely. In the early phase of our tightening cycle, our main priority amid surging inflation rates was to exit our accommodative policy stance as quickly as possible. While the policy challenge was immense, the policy path was relatively simple to calibrate. But as rates rose and approached restrictive territory, calibrating our policy stance became more complex. We first had to assess how much rates needed to rise until they were sufficiently restrictive, and then for how long they needed to stay at that level. But our assessment was blurred by much lower than normal visibility of the future. Our forecast repeatedly under-predicted inflation by large margins, even at shorter horizons. From 21 to 22, for example, the absolute inflation forecast errors in the staff macroeconomic projections, despite their best efforts, 1 quarter ahead, was more than doubled, largely owing to volatile energy prices. At the same time, the mix of shocks that emerged from the pandemic and its aftermath, and I will list them, I'm sure you can add a few, but I will try. Rotations in spending, energy spikes, particularly gas, bullwhip cycles in the manufacturing, supply bottlenecks, tight labor markets, fiscal expansion, reopening effects, and I'm sure you can add a few to that list. But that mix of shocks heightened the risk of inflation becoming more persistent. We faced a highly unusual conjuncture of high inflation and declining real wages, but also, at the same time, rising employment. And this combination essentially implied a multi-year catch-up process to make up for real wages loss. And in turn, and I spoke about that phenomenon last year actually, this could have triggered what I referred to as the tit-for-tat inflation dynamic. And we faced uncertainty as to how quickly and forcefully our monetary policy response would succeed in bringing down inflation. The ECB had not been through a tightening cycle for more than a decade. And there were reasons to believe that the transmission of monetary policy to firms, to households, might have changed. Take the prevalence of fixed-rate mortgages as a point in case. So to calibrate policy accurately, we needed a framework for policy decisions that would work when we had low visibility and that would mitigate heightened uncertainty. This is why we built our monetary policy response around the 3 criteria that I referred to earlier: the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. And this approach made our decision more robust, as the inflation path we foresaw in our projection had to be validated by data. And data that we could observe in real time, and that we could extrapolate into the medium term. That required a bit of an intellectual effort, by the way, and I'm glad that we were able to do that. But that in turn enabled us to take forward-looking decisions with a much higher degree of confidence. And it served us well in practice. The 3 criteria helped us map out the remaining climb, allowing us to bring rates to sufficiently restrictive levels to break the persistence of inflation, but also by guiding us to carefully evaluate the strength of policy transmission. So this helped us reach the decision to stop rate hikes in September. That takes us into the second phase, which is the holding phase, the one that we are now in the current phase of our policy cycle, which is a phase during which we committed to keep rates at restrictive levels for as long as necessary. Since the start of this phase, inflation has been declining consistently, and our projections have been showing inflation returning to our target over the medium term. We now project inflation to average 2.3% in 2024, And we then expect inflation to decline to 2% in 25 and 1.9 in 26. And I mentioned those numbers with much more confidence. Unlike in the earlier phase of our policy cycles, there are reasons to believe that the expected disinflationary path that we have observed will continue. Why? Well, first, for some time now, inflation outturns have been broadly in line with our expectations. Broadly. In 23, we saw a reduction of about 70% in the average absolute error in our staff projections relative to 22, 1 quarter ahead. Second, we now see inflation returning to 2% earlier in our projection horizon than before, mid-25, and not exceeding our target for the remainder of the horizon. Third, the composition of inflation is improving as we now expect lower core inflation in the medium term. And this suggests that the convergence to 2% is likely to be more durable and less beholden to assumptions about commodity prices, notably, although the commodity prices can always prove hazardous. The other criteria are also becoming more consistent with this improved inflation outlook. The transmission of our monetary policy is unfolding in the right direction. Financing conditions have reacted strongly to higher rates, loan demand has weakened, and in turn, activity has slowed notably in the most interest-sensitive sectors of our economy. And underlying inflation is generally easing. Nearly all the measures that we track are declining, and the range of readings between the different measures has narrowed from 4.1 percentage point at its peak to 2.4 percentage points today. Some of the measures of underlying inflation with the best leading indicator properties for future inflation have dropped significantly. So, well, at the same time, domestic price pressures remain strong. Services inflation is still stubborn and hovering around 4%, while momentum increased somewhat in February. And our indicator of domestic inflation, which measure items with a low import content, stands at 4.5%, at the top of the range of underlying inflation measures that we monitor. And this measure as well has been found to have good leading indicator properties. So why is that? Well, these pressures largely reflect robust wage growth as the catch-up process continues, as well as a tight labor market that has so far been resilient to the slowing economy. Employment grew by 2 million cumulatively during 2023, even as the economy stagnated, while firms continue to hoard labor. This pattern is mechanically lowering labor productivity and pushing up unit labor cost. And at this stage, it is difficult to assess whether these price pressures simply reflect the lag in wages and services prices and the pro-cyclical nature of productivity, or, that's the other explanation, whether they signal persistent inflationary pressures. So although we have made significant progress in all three of our framework criteria, we are not yet sufficiently confident that we are on a sustainable path towards our inflation targets. And that takes me into what will be the third phase. The essential question is, what do we need to see? What do they need to see is the question that I occasionally see. What do we need to see to become sufficiently confident to start dialing back our restrictive policy stance? Well, put simply, we need to move further along the disinflationary path. And there are three seems like a magic number, three domestic factors that will be decisive to ensuring that the inflation path evolves as we project it. And I'll take each of the three briefly. The first factor, as you can imagine, is wage growth. Our forecast sees nominal wages slowing to 3% over the next 3 years, allowing real wages to fully catch up to pre-pandemic levels over the projection horizon, also including productivity gain. But with the unemployment rate expected to remain very low at 6.6%, this wage path cannot be taken for granted. Sensitivity analysis by ECB staff shows that if there were an earlier full catch-up by the end of this year, 24, inflation would rise to 3% in 25 and only fall to 2.5% in 26. This is sensitivity analysis work. The second factor that we will be looking at very carefully is profit margin. The compression of profit margin of late has allowed wages to catch up without further accelerating inflation. Unit profit accounted for more than 50% of the GDP deflator in the last quarter of 22. Fast forward to the last quarter of 24, this figure is down to 20%. But again, our sensitivity analysis shows that if firms were to regain pricing power as the economy recovers and profit margins were to rise by an accumulated 1 percentage point more than we project until the end of 26, inflation would be at 2.7% in 25 and 2.4% in 26. To the sleeping lawyer inside myself, it says one thing: antitrust authorities better get their act together and make sure that concerted practices, market sharing practices should be fought as much as possible. The lawyer goes back to sleep. The third factor that we will look at is productivity growth. Hello, Professor Ising, it's lovely to see you. So the third factor that we will observe is productivity growth. We expect that a pickup in demand, if accommodated by fully utilizing hoarded labor, will lead, will lead to rising productivity growth and falling unit labor cost. We project labor productivity growth of 0.1% this year before it rises to 1.2% in 25 and 26. But the path of inflation could be different if in a new geopolitical environment that you have referred to, Professor, productivity losses for European firms turned out to be partly structural. And there will be a fascinating panel with my colleague and friend, Mrs. Schnabel, Professor Schnabel, I should say, this afternoon on these issues of structural reforms. On this particular point, by the way, the competitiveness desperate search that we are conducting in Europe at the moment is also fundamental to that particular point. Given the delays with which these data become available, we simply cannot wait until we have all the relevant information. If we were to do so, we could risk being too late in adjusting policy. But in the coming months, we expect to have two this time, important pieces of evidence that could raise our confidence level sufficiently for a first policy move. So let me take each of these two. First, we will have more data to confirm whether wages are indeed growing in a way that is compatible with inflation reaching our target sustainably by mid-25. And my great chief economist, Philip Lane, mentioned to me this morning that we are getting numbers that are heading in the direction that we expect. And that is good, but not enough. So the latest data point in this direction. Growth in compensation per employee edged down to 4.6 in the fourth quarter of last year. So Q4 23, 4.6, slightly below our March projection, but from a 5.1 percentage point during the third quarter of 23. That's for CPE. If we look now at negotiated wage growth, which accounts for the lion's share of compensation per employee growth, it also decreased from 4.7 to 4.5 in the last quarter. Similarly, because we try to have as many indicators and measurements as possible, the ECB's not backward but forward-looking wage tracker, which anticipates the development of negotiated wage growth in the euro area, is also showing some early signs that pressure is beginning to ease. Average growth, wage growth in 24 for all existing wage contracts fell from 4.4% at the time of our January Governing Council meeting to 4.2% at the time of our meeting in March. These coming months will help us form an even clearer picture and understanding. We will receive data on negotiated wage growth in the first quarter of this year at the end of the month of May. And many wage negotiations are currently taking place in large sectors throughout Europe, the outcome of which will be entered into our wage tracker as soon as negotiations are concluded. Employees whose contracts ran out last year and have not yet been renewed or will run out by March 24 account for around 1/3 of those in our wage trackers. So that was the first piece of evidence that we are observing very carefully. Second, by June, we will have a new set of projections that will confirm whether the inflation path we foresaw in our March forecast remains valid. These projections will also implicitly give us more insight into the path of underlying inflation. We will have more visibility on the strength of the recovery and the likely direction of the labour market, and therefore on the consequences on wages, on profit, and on productivity. In addition, we will have had a longer window to assess whether inflation data continue to fall broadly in line with our projections. If they do, we can be more confident that our models are now more accurately capturing inflation dynamics. And this confirmation will be particularly important for the more persistent components, such as services, so that we can trust that these components will continue to decline in keeping with their typical lagging pattern. If these data reveal a sufficient degree of alignment between the path of underlying inflation and our projection, and assuming, of course, that transmission remains strong, we will be able to move into the dialing back phase of our policy cycle and begin making policy less restrictive. But thereafter, domestic price pressures will still be visible. We expect services inflation, for example, to remain elevated for most of this year. So there will be a period ahead where we need to confirm on an ongoing basis that the incoming data supports our inflation outlook. So this has two important implications for the policy path ahead. Two important implications. First, our decisions will have to remain data dependent and decided meeting by meeting, responding to new information as it comes in. This implies that even after the first rate cut, we cannot pre-commit to a particular rate path, however tempting that is, however much some of you would like to see it. if we are honest to our methodology, and if we have discipline in adhering to these principles, we cannot. That was the first important implication. The second important implication is that our policy framework will remain important to process the incoming data and calibrate the appropriate policy stance: inflation outlook, dynamics of underlying inflation, transmission of monetary policy. But at the same time, the relative weights assigned to the three criteria will have to be regularly examined. So, in conclusion, I said after our last Governing Council meeting that when it comes to the data that is relevant for our policy decisions, we will know a bit more in April and a lot more in June. I hope that my remarks today and the developments that I've taken you through will help understand our analysis, our logic, and our method. So in the coming months, we will receive more data, which will help us assess whether we are sufficiently confident in the path ahead to move to the next phase of our policy cycle. I thank you for your attention.